Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of being sold financial products they don't understand or need. So if you're tired of being a transaction, go ahead and hit that notification bell and also the subscribe button so you never miss another video from us. How are you today, Brian?
Hey, Michelle, doing great. How about yourself?
Fantastic. So in today's video, we're going to be covering variable annuities, specifically what are they, pros, cons, how they work, information on taxes, the whole 9 yards. So this is really an in-depth video we're explaining variable annuities.
Awesome.
Let's do it. So let's just start. Some people know what a variable annuity is. Some people think they know what a variable annuity is. And there are other people who have no freaking clue. So
and don't know if they even have one. So
exactly. That's another thing. So let's just dive in. What is a variable annuity?
Quite simply, Michelle, it's just a tax-deferred retirement vehicle. Basically, it's a contract between you and an insurance company. Mm-hmm. And usually what happens in this situation, the insurer agrees to make periodic payments to you, whether it's immediate payments or deferred at some future date.
Okay. All right. And so how do they work?
Well, a variable annuity is quite different from like a fixed annuity, sure, where all you have is just a fixed rate of return for X amount of years, right? Well, this is different because it uses a range of different investment options. Okay, you could be in stocks, bonds, mutual funds, money markets, combination of all of them. And sometimes them accounts inside the variable annuity, Michelle, are called subaccounts. Okay. Now, once you've got this account, it's used to accumulate funds for your retirement. Once you reach retirement, you have several options to withdraw your funds depending on how the contract's set up. Now, there's such a wide range of contracts out there, Michelle, that you really need to read the fine print of each one because they are quite different. So,
really, I mean, that's the one thing we've done quite a few videos on annuities, not just covering all of them, but we've done them fixed, MIGAs, you name it. And that's the one thing you keep coming back to is it's contract. Look at the contract. It varies from contract to contract, and then also issuer to issuer or insurance company.
Right. Yeah. So you got to be careful on that. You just understand what you own today, and we hope this video helps you with that. So when it comes to how a variable annuity works, Michelle, there's two different phases in it. One is the accumulation phase. Second is the distribution or the payout phase.
So let's start with the accumulation then.
And this is pretty simple. Accumulation is basically how the time period where you're depositing funds into this account. Now, it could be your accumulation period could be immediate. You drop in one time and then start taking an income off of it. But what we more rarely see in the variable annuity space is someone making continuous payments for a long period of time, kind of like your 401k at work, where you consistently put in every time you get a paycheck. So this is the same. You, with a series of payments, when these funds go in, Michelle, as you're contributing, you buy the stocks, the bonds, whatever's in these sub-accounts. Mutual funds is more what you'll see inside of these. And you decide where you want to invest these funds, basically determined by your risk tolerance.
Risk tolerance. So you can, in fact, decide. It's not like here's a variable annuity, number 1, number 2, number 3, and you pick one. You say, I want a variable annuity, and here's a selection I want based on my risk tolerance. Or if you're working with a professional, they help you, a financial professional, they'll help you do that.
You're exactly right. Kind of like when remember we talked about 401ks before, and you got this huge investment menu of options that you can invest in. It's similar to that. So you'll see like several pages of it. Here's what you can invest in, and based on your risk tolerance, does this make sense for you? And what we see during the accumulation phase a lot, Michelle, is people putting in $25 a month, $50 a month, and
so they're dollar
cost
averaging into the
contract.
During that accumulation phase. Okay. So what about, you mentioned the payout phase or the distribution phase?
Okay, so this is where it gets fun. This is the, you've accumulated your wealth, right? Once you reach retirement, now you have several options to take your distributions, depending again on that contract. Each contract's different. So here's some simple, normal distribution methods. Our income payments is one, and that can be set up as payments for life, joint and survivor payments, and period certain payments where they continue for like a 10-year period or a 20-year period. So
Okay, quick question on that joint and survivor. What is that? Is that, I mean, I'm assuming that's for you and your spouse or your partner?
Right.
Is that what
Yes.
that? Okay.
Yeah. So back to like, compare this to when you choose your pension options for those that have pensions, and you get a range of options. One is a lifetime payment based on your life expectancy, you as a person, right?
So that's payments for life.
Yeah. And then second, take it as you have a spouse and your payments, you want payments to continue to your spouse. God forbid you pass away early. So there's where joint and survivor payments come into play. And then back to the period certain, this is you telling the insurance company that I want to take my distributions over a 10-year period, 20-year period, or for the rest of my life. So.
Okay. Okay. And so what you said, that was under income payments. What else is there?
Okay, so systematic withdrawals is, to me, the most common one that I have seen out there in my 23 years in the business. You choose how much as the consumer and how often you want to take these. Monthly interest is a very common one, Michelle, where, you know, the market's still doing well, my account's still growing, just pull me some interest off on a monthly basis, or a set amount. A recent one that I've done, the young lady decided that she wanted to take out $1,000 a month out of her account for the rest of her life. So we just set up $1,000 a month, which was basically, it was actually less than what the account was earning. So.
Okay. Okay, so we have income payments and we have systematic withdrawals. What's the third, or what else is left, I should say?
Yeah, the third one, Michelle, would be lump sum payments. And we don't see that one that often. And basically you're taking the whole lump sum all at once. And the reason why we don't see that very often, Michelle, is the fact that taxes are due immediately on all that. Do you want to pay taxes on a big distribution of your wealth after you accumulated it for 30 years, maybe? No.
No. I have some tax questions in a bit, but I just want to, let's keep going with, we've talked about what it is, how it works, the different phases, accumulation and distribution. So let's talk a little bit about some of we've mentioned them, but let's list them out, the advantages of a variable annuity.
The biggest advantage, Michelle, to me, and what we've seen out there is the tax-deferred status. No taxes are due until your funds are actually withdrawn. Another advantage is the growth of your portfolio based on the investments that you have chosen inside them subaccounts. And
Okay.
let's take that one more step further. The growth, Michelle, could help offset inflation. And guess what? That's where we're at right now, a period of high inflation. So your investments today have to outpace the inflation aspect of society today, and a lot potential higher returns than what fixed annuities actually offer.
Provide. Okay. All right. And what are some disadvantages then?
Big disadvantage. Number one, to me, the investment risk. Investments you choose could decline in value, which could lead to lower income payments in the future.
Okay. And there's nothing you can do about it, right? Because
you're in the market. And remember, you're choosing these investments based on your risk tolerance. So make sure you're willing to accept the amount of risk based on the investments that you choose inside these portfolios.
Okay. What about fees? Is that another disadvantage, or what do fees look like?
Yeah, we could go pretty deep into this. We'll save that for another video, but let's just say on an average variable annuity, annual fees are 5% or more. and they will cover the sales commissions of the advisors selling the product to you, ongoing management fees, cost of insurance charges, and they call them mortality and expenses, M&E charges. So them are inside there. Penalties. You could also have penalties, Michelle, if you withdraw before age 59 and a half. Remember back in the beginning, I said variable annuities were a retirement savings plan.
So the 59 and a half rule applies to this
rule
as well,
comes in if you're saving for
as it does with
retirement.
IRAs and with 401ks. Okay.
Yeah, so 10%
penalties
penalties from the IRS. And one of the biggest things that's inside every one of these variable annuities is what's called surrender charges.
Mhm.
And these products, Michelle, are made for investing for the long term. So for an insurance company to figure out their profit on these type of products, the longer the duration the product is, the longer the surrender charges could be. So if you cash out of the product early, the insurance company is losing money, so they're going to charge you a surrender charge for leaving them. And then penalties, Michelle, could be surrender charges and penalties could be as long as 15 years in a lot of these products.
Okay, yeah. So again, goes back to read the fine print of your contract, know what you're getting into.
Understand your risk and know for a fact how long you plan on keeping this product.
Okay.
Don't put 100% of your IRA money, non-qualified cash, whatever it may be. Don't put it all into one product, knowing that there could be a 15-year surrender period here. So.
Right. Okay, so one of the advantages we talked about was this is, variable annuities are tax deferred, meaning you're not taxed until you pull the money out. So let's talk about how are they? Like, how is a withdrawal taxed?
Okay, so real simple, ordinary income.
Okay.
As the funds start coming out of here, they're going to be taxed as normal income. Very rarely do you see capital gains taxes in these products unless the product was specific for like estate planning. But
Sure.
most of
And
the
I think
time,
that's
ordinary income.
Yeah, that's something people, I've heard people ask, hey, about variable annuities because you're in the market and that typically is capital gains, but this is not. This is going to be taxed for the most part, unless there's a caveat over there, but for the most part, it's taxed as ordinary income.
You got it.
Okay. Which is why, again, we talked about the lump sum, why people don't do that. It's a lot of tax to pay.
And it's funny. And also to follow up on that, Michelle, I get questions all the time. Okay, so why, if I have a variable annuity that's not an IRA, IRAs come out as normal income, ordinary income when you taxes ordinary income when you withdraw, right? Well, what if I have cash and I put cash into a variable annuity and let it sit for 20 years? Well, if I did that with mutual funds, I'd be taxed as capital gains, right? Well, why is it set up this way? Well, because by default, a variable annuity is designed as a retirement savings vehicle.
Okay.
So again, it goes back to the contract that you have initiated with the annuity company.
Okay. All right. So let's talk about death benefits and variable annuities.
Okay. That's morbid.
Hey, we're covering all of
question we get asked.
So what happens if you pass away before you start taking benefits?
Well, it's just like any other type of account out there, Michelle. You make sure, I'm glad we're talking about this, because make sure that you set up a beneficiary on this account if you buy a variable annuity. Make sure your beneficiaries are in place and make sure you review them on an annual basis if something changes. Let's say you don't want your Johnny's was the perfect son, well, Johnny's no longer the perfect son, so you don't want to receive these benefits, right? If you pass away. So make sure you change this stuff and update it if things happen. So, yeah. But it's a standard payout, Michelle. Basically, if you have 100,000 in the account and that's the account value when you pass, that's what's going to go to your heirs, whoever you list as the beneficiaries. But and again, depending on the contract, one of the caveats of these is, remember, we're in the growth phase. And as these accounts keep going up and up, some companies have what is called a locked-in value. So let's say the account grows from 50,000, Michelle, to 150,000. And then we have a drop off in the market and it's back down 100 and you have a heart attack and you pass away. Well, some of these variable annuity companies will lock in that $150,000 value to your heirs. So each year, read your statement. When you receive your annual statement on this, it'll show your account value, your surrender value, and you might see a death benefit value listed on there. Remember, this contract is between you and an insurance company. So they're going to.
That's also a question to ask if you're watching this right now and you're looking into variable annuities, ask about that.
Yes.
Right. Yeah. Ask about that if they lock things in or they lock in a certain value as you accumulate.
And Michelle, that's another reason to work with a fiduciary that will find you the best product available for what your needs are versus just selling you a product for a commission. Okay.
All right. Then anything else on taxes? Let's see. So what we have covered, what happens if you die? Here's one. How are variable annuity death benefits taxed?
Basically normal income to the heirs.
Okay.
Capital gains, some of them, depending on how the contract is written, they don't see that very often. And these bypass probate, another benefit.
And that's another question to ask then, right? If you're if you don't have, or even if you have one and you're not really sure what's in your current contract, finding out how that death benefits are taxed so that no one's surprised.
Gotcha. No, but stay tuned for this. I'm glad we're near the end of this video, but stay tuned because we will soon be doing, let's say you have a variable annuity and you watch this video and you're thinking, wait a second, I didn't know that.
Yeah.
You didn't understand something about it. One of our future videos here in the next few weeks, we'll have a video on the questions to call your insurance company, whichever variable annuity company that you have your contract with. If you don't know something, we're going to give you a list of questions to call them and ask these questions so you truly know the product that you have today. Awesome. I can't wait for that video. I probably need to call mine. We're going through these videos. Yes. All right. Yes. Wonderful. This is fantastic. If you found this information helpful, we'd appreciate the thumbs up, like sign, hit it, smash it, touch it gently, whatever you want to do. And also make sure to subscribe to our videos so you never miss another one. Again, we not only cover annuities, but 401ks, IRAs, just investments in general, and just making sure that we're providing the best information possible so that you can make an informed decision. All right. Thanks so much, everybody, for watching. Thanks, Brian. Thanks. Thank you. Bye.